How's it going out there? It's Tuesday, September 20th. I'm Frank Curzio. It's the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. We have a big day tomorrow, and I'm bringing in my buddy Daniel Creech, who he's bringing on Wednesday. But there's a lot going on with the Fed. Everybody concerned. The market's all over the place. Been going down over the past few days. And Daniel, I've just been talking about a lot what's going on, and I wanted to bring him in. Daniel, thanks so much for coming in on a Tuesday. It's not Wednesday.
I know. This is not, people at home listening, do not adjust your calendars or anything. You're not mistaken. It's Tuesday, not Wednesday. So that's good. We don't want to get everybody off on the wrong start, Frank.
So we've been having some really good conversations about the Fed. It's mostly me ranting, I think, in the office.
I rant too.
Like, I'm trying to get somebody to explain to me what the Fed is doing, and everyone I talk to can't do it. So tomorrow is a big day where the Fed is expected to raise by 75 basis points, which shouldn't be too much of a surprise there. However, there are also some surprises that I think. One is that I think it's funny that the probability of recession as of right now by the futures is 52%, which is funny because we're already in a recession, and we'll determine that later on. 52%. By the way, I think it was leading up to 2008. I think there was like 35% of the economists and everything, like the same gauge was basically showing 35% chance of recession. So just to let you know, this means there's a guarantee at 50%. It's like 110%. Just to let you know, those are fucking numbers. Sorry, I'm not. You know what? I'm not going to curse. I'm not going to curse because I'm going to get emotional. I'm going to get pissed off because I get fired up about this stuff. But here's what's a surprise, Daniel. The peak rate is expected to be 4.26%, right? So where are we now at 2.5%? They're expected to raise 75 basis points, which is going to bring us to 3.25%. And then we're expected to get to 4.2%, 4.26 pretty much by February, March. But we should get to 4%. And a lot of people believe we're going to get to 4% this year. Now, the surprise here is that it's supposed to stay there. They're projecting for at least 11 months at peak. At 4.2%, at 11 months, right? So we're at how many months? Just a few months, and we're seeing the effects of housing. We're seeing the effects of FedEx. We're seeing the effects of companies warning like crazy. We're at 2.5% right now, and the last 75 basis point hike didn't even filter through the system yet. That's going to take a few months. It usually takes like 6 to 9 quarters, maybe a little sooner, but you're seeing it already, right? And we're going to bring it up tremendously from here because we see inflation. That's what's projected for tomorrow, at least 75 basis point. Should we expect any surprises? I mean, or just going to be, the Fed saying that we're going to do everything we can. We're not seeing any signs at all that inflation is moderating, and pedal to the metal. We're going right up to 4.2%. What are you expecting for tomorrow?
I didn't see the last percentage or what the futures were doing, Frank, but the 75 is all in, 75 basis point hike tomorrow. Is 1%? That would be the only shock, and I don't even think that's a shock. If the Fed comes out and raises 1%, I think that would be a headline, but I think 75 or 100 is not going to. I'm not saying markets won't be volatile and move lower. I just don't think, I think a real shock to get that word, for me to use that word, he'd have to go over 1%. I don't think he's going to do that. No. I do think he's going to remain hawkish because I want to cover a couple things in a great article today at Wall Street Journal, which makes me, we kind of got to dove into the, minds of the smartest people in the room, so to speak.
Go ahead. Yeah.
Well, so there's a lot of take on how hawkish or how dovish he will be. You and I have been in the same camp about, hey, at some point they're going to have to pivot, and be more dovish and talk about lowering interest rates and things like that. That's when more risk assets will take off. I've been wrong on that up to this point. I thought he would have already signaled a little bit of that. But let me tell you this, Frank. So today's paper, the Wall Street Journal, has a good article, and it says Powell draws from Volcker's playbook. Volcker is how do you say that? He was in a ton of different, he helped Nixon with the, advising him with getting off the gold standard. He was treasurer.
He's the one who went crazy with interest rates and controlled inflation. And they thank him for it. They're like, okay, they control inflation by raising rates significantly in the 80s. And everyone's like, that's, again, we're looking back at policy that was, 4 decades old.
And it's not apples to apples. I agree with you. Mm-hmm. And the Wall Street Journal this morning talks about how Powell is looking at, or the market was kind of looking at how they would react to the 70s. And that was under Fed Chair Arthur Burns, who, much to the same playbook as our recent Fed, like Bernanke and things, anytime the market got upset or sold off hard, when you have low interest rates and all that pre-COVID, you basically just switched it and went back to easing, or, you put out some dovish comments. One thing to your point, Frank, is they cover a couple of quotes here, and this is from St. Louis Fed President James Bullard. He says, I don't really see why you want to drag out interest rate increases into next year. This is in reaction to getting to 4%. So you just said that triggered me reading that. So he is simply saying, hey, there's no reason to drag this out. It's basically equivalent of ripping the Band-Aid off, trying to get over the pain trade or whatever. My concern here is that, first of all, did you know that the Jackson Hole speech that Powell recently gave, where I forget how many times he used the word pain, but he used it a few times. Do you know that the Wall Street Journal is reporting, Frank, that was not his original message into Jackson Hole? So looking behind this theatrical play that's called the Fed, Frank, you and I are in the front row. We're eating popcorn, hanging out. Lights go down, show's on. We actually sneak backstage and see what's going on. Fed Powell was so upset, apparently, by reports that the market was rallying, and another Fed chair, and I'll find this quote in just a minute, who is unhappy with the market rally from August after that, thinking Fed pivot and all that kind of stuff. That makes me believe that they are going to be much more hawkish. Powell evidently just scrapped his speech of whatever he was going to say. He didn't like how the market was rallying, so he was more direct, said painful. They basically are hinting now or trying to get the market to believe that they're not going to reverse course anytime soon, that they're here to stay. And now these guys are really serious about inflation and they're going to do whatever they have to. Unfortunately, that's painful for investors. But when you have Fed chair and Fed members saying that they don't like, here's one, Frank. This is Minneapolis Fed President Neel Kashkari. Okay. He says, I was actually unhappy to see how Chair Powell's Jackson Hole speech was received. He said, I certainly was not excited to see the stock market rallying after our last Fed Open Market Committee meeting. Now, he's not talking about the market sold off after Jackson Hole. He was talking how it rallied from the previous meeting into Jackson Hole. My point to all that is, and then Mr. Powell closed the article with, the clock is ticking, Mr. Powell said in a conference on September 8th. The longer inflation is high, the greater the risk that the public will start to just naturally incorporate higher inflation into its economic decision-making. And our job is to make sure that doesn't happen. That is, for lack of a better term, Frank, balls to the wall, my friend. That is the biggest risk right there.
I think there's a good shot tomorrow that we could see a 1,000-point rally in the markets. There's a very good shot. And I'll tell you why. Because I don't know how he could be more hawkish, or anyone could be more hawkish. If you're looking at the trends of the money that's on the sidelines, the amount of money that's on the side, I mean, you're looking at things like near all-time highs, like sentiment indicators near all-time highs, meaning that they're contrarian indicators. This is how bearish, like people have never been more bearish than they are right now. Like in history, some of these indicators in history, right? This is like World War II. This is COVID. This is credit crisis. The world almost ended, right? So this is just inflation that's relatively high, but not the highest we've ever seen, right? And it is, again, it's going to come down just where rates are. But I love when they say the rip off the Band-Aid analogy, because you're not ripping off the Band-Aid. It sounds like it's like you're ripping off a quick. You got all this quick pain, and then you get it. What happens when you rip off a Band-Aid, right? It hurts like hell for about 10 seconds, and you're done. If you're bringing rates higher, it takes 6 to 9 months to filter through the system. It's not ripping off the Band-Aid. Okay, so I want to go over a couple of things here, because we've been saying this pretty much for ever since Jackson Hole. I was like, holy shit, the Fed is really serious. I thought they were going to, and the word pivot is so bad, because we are set in our ways, Daniel, where it's all and none. It's like politics, right? Everything's black or white. It's either you have zero carbon emissions or you think climate change is 100% bullshit. There's no middle, right? You have to have your state go 100% EVs, no matter what, like California, no gas cars by a certain date, or EVs are a complete waste because they really don't lower CO2 when you account for, the mining of cobalt, lithium needed for batteries, right? What about COVID? Everyone, Daniel, has to wear a mask 100% of the time. Everyone, right? Nobody should ever wear a mask. There's such a middle there, right? We know the people we need to protect. Kids don't ever need to wear masks, but yet people over 65 who have like this should need to wear masks. There's a huge medium, right? But everything's black and white. Why is the Fed black and white with this? It's not that you have to pivot where you're going to say, okay, not only are we done, but we're going to ease rates. No, they're not going to ease rates, right, for a very long time. They're not going to ease rates for a long time. They need to see much, much more evidence, right? Stopping and easing is two different things. You can raise tomorrow by 75 basis points, bring us to 3.25%, and say, you know what, we're going to wait and see with the data. The current hikes are not yet priced in that, because they take 6 to 9 months at least. And imagine they come out and say, we've seen inflation remain stubbornly high, right? Food and rents, we all know it. There are clear signs that higher rates are working to lower inflation. With the velocity of money, it's at the lowest level since the Great Depression. The money's coming out of the system clearly. We're seeing a lot of companies lower margin guidance, which means, you look at almost every industrial, FedEx, just so many warnings that I covered already, right? And this means they're no longer able to raise prices to account for their higher costs, which means that is the deflationary trend, right? You look at copper, you look at lumber, look at cotton. I don't think you've seen cotton. No one's really been talking about cotton. Cotton has crashed. It absolutely crashed. I mean, you look at cotton down 20% since Jackson Hole, down 40% since May. What's cotton used for? You guys can do the math when it comes to apparel. Okay, so that's coming down tremendously. Home prices are coming down, right? So there's clear evidence that what you're doing is working. But the Fed has inflation under control right now. It's not out of control like it was last year. I mean, Jackson Hole last year, they were saying, oh, it's going to be transitory, and it went from 2 to 5%, and you were like, it's going to be transitory. We've never been above, 3.5%? I think 3.8% once since the 1990s, annual CPI. Where you look at deflation, that's the Fed's gauge. So if you're looking at those numbers and you're seeing 5%, you need to be worried. The Fed wasn't worried at all last year. And they said it's going to be transitory. So what happened? They didn't do anything, and then it went to 8 and 9. Now you're out of control, right? Everybody's like, holy shit, the Fed has no... But where you are right now, you're in control. It went a little bit higher, but you're in control. You're in control. The rates are currently working. You were seeing it's working. Yes, we didn't get a good CPI number, but... You're looking to try to control inflation. And when you have a bunch of 80 to 100-year-old people who are on the Fed, and I'm not even kidding. I mean, they just had somebody, I'm not even going to mention his name, who could... Listen, I'm going to be the same way when I'm 85. But these guys are like, one, they don't care because they're extremely wealthy. They probably just, watch TV and hang out in the room all day and have, servants. But you're looking at data from the past that doesn't make sense. You're looking at the 80s. You're comparing, you want to be a Vockler. Vocker. It's really, that's who you want to be like from 1980, like 40 years ago, right? I mean, everything is so different to the point where you injected $11 trillion into this market. Now that $11 trillion, a lot of it is coming out of the market based on them too. You're seeing it. There's still a lot out there, but you're seeing it. So if you raise to 3.5 or 3.75 and just wait, inflation's going to come down. It's going to automatically come down. It's going to fall. It's just not going to happen as quick as you want, which is fine. Because the trade-off is a solid market for bonds and equities. It's predictable. You're seeing it come down. It's not like all of a sudden, say if I'm wrong, right? And the Fed does exactly what I just said that they should do, right? And just, take a wait and see approach, 35 basis points. Let's see the data, probably going to raise, but let's see. If they say that, one, the market's going to take off because it's going to be seen as, they're pivoting, even though they're not. But if I'm wrong and inflation happens and magically surge from here, right? All of a sudden, people are just going to decide to buy homes like crazy despite mortgage rates doubling in 9 months, right? They're going to look at 6%, over 6%, 6.5%, pretty close now, and be like, oh, I am going to buy a house, right? Which is not going to happen. Now, housing market, it's almost frozen now. That's one of the biggest drivers of GDP to the point where we may see 3 in the next 5 quarters, maybe 4 in the next 5 quarters. Not next quarters, and counting the 2 that we just went negative, be negative. 4 or 5 quarters could be negative. We could see negative GDP. We're likely to see that if you keep raising rates. But it's more predictable. If I'm wrong, then you can raise rates, right? Wait, and if you happen to see inflation continue to rise next month or the month after, then you raise rates. But to say you're going to keep them at 4% plus is insane. Through the whole year 2023, and this is why it's so unpredictable, okay? Because the Fed's project to keep rates above 4% right now for all of 2023. But the conference board, right, which is widely used, again, everybody looks at the conference board and stuff, they report, right? They believe GDP is going to grow. This is their prediction, though. They believe GDP is going to grow by 5% for the second half of 2023 with rates over 4%. I'm not going to curse. I'm going to be nice.
Say Florida. I
guarantee there is, I won't even say a 0.1%. There's 0.000% chance that it's going to happen. Okay, you're not going to be at 4% and the economy's magically going to grow at 5%, right? It's not going to happen in the second half of the year. That's the disconnect you're seeing because they really don't know. So, 4.25 and keeping there for all 22, it's insane. It's not rational. I mean, you're going to destroy the market. When you see companies like the Dow, Intel, Salesforce, Nike, Walgreens, they're down 35% each. These are staples. Could we come down with stocks a little bit more? Yes. Apple's 24 times earnings, Nvidia's 35 times earnings, Google's 18 times earnings. Disney's 30 times earnings, and that's based on earnings this year of 380, and the forward PE is based on them earning $5.40 next year, which is insane because you're losing billions and billions. So, they're really trading at 40 times forward earnings, regardless. The stock market can still come down, but if you're really going to raise rates, finally we're seeing a lot of people come out, like pretty smart people. Scott Minerd, Guggenheim Chief Investment Officer, Guggenheim managed over $300 billion. He's saying that, we're going to go down another 20% at least. He says it's going to end in tears. So the current PE of the S&P 500 is 19x. And he goes, since 1960, when core PCE year over year was 4.5% to 5%, as it is today, the S&P's PE was 15.2, right? And where are we now? We're at 19. We're not really at 19. I think we're more like 17. If he's looking at forward rates, if not forward rates, I think we're more like at 19 currently. So he says, we could see it go down to 15.2, and that's going to be a nice steep decline. But also, Ray Dalio expects stocks to fall 20% if rates rise to 4.25%. But in January 6th, okay, I went back to see what Dalio said. In January 6th, he also said the Fed tightening won't derail the bull market. And he was right. The Fed tightening won't derail the bull market. It has. But you know what has? Because in January 6th, we were predicting 4 rate hikes. And we didn't even discuss 4 rate hikes meant 4 25 basis point hikes. No one, they were like, they're not going to raise by 50. Now they're raising by 75, 3 quarters in a row, and they might do it 4 quarters in a row. Are you freaking crazy? And then last month, and this was under the radar, which no one really picked up for Ray Dalio, because again, this just came out the other day that it's going to fall down. Mark's going to fall another 20% if rates rise to 4.5%. He said that like last week. But last month, he said stocks will fall another 25% as the current rate hikes are not priced in. The current rate hikes are not priced in. The current ones, not the ones that you're about to do like crazy, right? Not the 1.5% you're expected to rise from here, right? So think about that. He's like, the normal relationship between cash flows, asset price means a significant decline to come in to align the real economy with the financial economy. So we're looking at markets where, why is it all or none, Daniel? I mean, I know I've been talking a lot, but why is it all or none with the Fed where it's either, people think they're going to pivot. I mean, to me, the pivot is just saying, listen, we're going to raise rates accordingly, and we may raise, if they come out and say, because what are they going to say? You even said it, Daniel. They're going to be hawkish than ever. How much hawkish could they be? How much hawkish could the Fed be right now? They just said 75, there's a 20% chance that they're going to price it at 1%. They already said expect more pain. Everyone is predicting that they're going to come in and say, they already said we see 0 signs. We see no signs inflation is moderating. So what are they going to, if they come out and say we see no signs of inflation moderating and we're going to continue to raise rates after a 75 basis point hike, that's priced in right now. That's why the market's gotten crushed the past week. So if they come out and say, which I think they should say, that we're seeing some signs, but we're not there yet. Even if they say that line, we're seeing some signs, but we're not there yet. So we're going to monitor this. But if we continue to see some of these things remain stubbornly high, then we're going to raise rates. The market's going to go up 1,000 points tomorrow. And there's a possibility that they could say that. I give it 50-50. They could say that, which is still hawkish. But now you're saying, okay, we are seeing some of these things. We saw FedEx warn. When did FedEx? I can't remember. You guys tell me. When did FedEx ever? 2007, 8 maybe, during the crisis, remove their guidance. They have no idea because they just saw in the last month and a half that they saw business absolutely crash out of nowhere. New core, record earnings last quarter, immediately they're like, the earnings going to be, they lowered earnings by 33%. Going into next quarter, they had a warn. So you've seen these companies warn out of nowhere because demand's falling off. Ford's another one. They're like, well, inflationary concerns, supply chain. Who the hell is buying your cars? Who the hell is going to buy your cars? Yes, there's a backlog of orders and people are going to buy it, but really? I mean, it's not just the inflation. What they're saying is we're not able to pass that inflation off to customers anymore. That's what Ford said. And now you're looking to sell all these EVs, which are 35, 40% higher than they were in a recession when people are getting murdered. I mean, just come out and say it. It's not just the supply issues where, supply and you're seeing prices go up a little bit. I mean, demand destruction across every single industry is happening immediately right now. And you didn't even go up. You didn't even talk about 75 basis point hike for tomorrow. So the Fed and again, this is a trading opportunity. I'm not saying that you should be the Fed controls a market where they can make this a lot more orderly than they're making it. They don't have to say, well, you got to feel the pain. We're feeling the pain and we're going to feel the pain. If they do nothing, we're still going to feel the pain. At this rate, we're still going to feel the pain. The SPAC market is dead. We'll talk about that in a minute. IPO market is dead. Money completely flown out of the market. Money on the sidelines. It's just everyone's out of this market right now. The dollar's freaking going, it's surging because the more you raise rates, the more emerging economies are dead. They're filled with debt. Look at the developed economies. Look at Europe. GDP, you think ours is bad, 100%. Check out Italy, Greece. Check out most of Europe. Holy shit. Look at China's numbers. I mean, come on. I mean, are you really just going to go? I mean, you're accomplishing it. You're seeing it. All you have to do is wait, but they're not going to wait. They're going to go pedal to the metal, and that's pretty scary to me.
Yeah, absolutely. The FedEx numbers were shocking because the guidance that they gave for 2023 that they just pulled, they only gave that guidance 3 months ago. So to your point, that is a quick 180. I mean, to say that's a turnaround is a very understatement. Nucor is basically a big bellwether for steel, so that was important. Ford, the thing that stuck out.
Keep Ford. Keep the Ford comment. And
Okay.
you know what? You know why they're doing this, right? And this is listen, just think a little bit.
Who are we talking about here?
Talk about FedEx.
FedEx, gotcha.
Why do they pull their guidance? What's coming up? The biggest season for everybody, right? Which is the holiday season. They're pulling their guidance because they understand where the companies are coming from. You're going to see demand fall off a cliff. There's lots of inventory out there, and they really have no idea. Like, they're expecting Christmas to be absolutely hard. For them to pull their guidance, they're expecting, and they have their eye on the pulse. They see exactly what's going on with orders and ramping up and how many people. They know every business. They've been doing this for freaking decades and decades and decades. They know this industry. And with the holiday season coming up, right, we're seeing it, just a couple months away, not even, a couple weeks away from Black Friday. And you're going to see, right after Halloween, the Christmas sales and stuff like that. They're really, really worried about the holiday season. That's what they're saying. Again, go into Ford.
Yeah, I agree with that. I just, when you yank it, like you yank that kind of guidance, that's incredible. The Ford, the only thing that stuck out to me, I mean, you've been on the steady bandwagon of calling them out for them saying the supply chains are always easing.
Just don't lie to the public. I hate that shit.
The big thing there was they expect $1 billion in cost and supply chain and material costs and things that the way I read it, and I could be wrong, but it was $1 billion additional from like what they thought previously. Well, I mean, in this day and age, it's kind of funny. Everybody just like, oh yeah, $1 billion. That's a lot. I mean, that's a crazy amount of money when you're like,
bottom line.
Hey, what's this going to cost? Oh, it's going to cost $1 billion more. That's a lot.
But the thing is, now what do companies do, Daniel? Well, all right, we're seeing billions in costs. Let's raise prices. Well, you just raised price by 35% for EVs. How much more can you raise them? You can't, because people aren't going to buy EVs if you do that. And we might not see that many people buy EVs. We still don't. I mean, you look at the Teslas. If you listen to Tesla owners, they love their Teslas for the first year. And then you read the comments on the second year and third year, and that's because, again, it's a new technology. It's brand new, but, replacing the batteries for some of these things and getting them fixed. You see, like, the complaints come in after 2-3 years. People are like, I own my not everybody, but, what's going to happen when these guys are releasing these first-generation trucks? I mean, already with the Lightning with Ford, you saw that once you tow something, I mean, it uses, like, what was it? I don't want to even guess a percentage, but a massive amount of the battery where, it was supposed to travel a lot further, but yet if you're towing like you normally do, and a lot of people do with these big Ford trucks, F-50 has been a winner for decades, the greatest truck ever. Now you're seeing, again, these are things they still need to figure out. I mean, the recalls are going to be enormous with these cars. So,
yeah.
But anyway.
If you're buying a Ford, if you're buying a electric pickup truck to haul and do anything of any merit, you're a fool and you should pay $100,000 and be disappointed. Yeah. That's with where we're at right now in the grand scheme of things. You don't have to be an engineer to understand that. You can just look around and read reports. Anyway. Are we segueing into the last segment? Because I got to give a comment. There's no way. I love you, Frank, but I'm going to bet against you on this. There's no way we get through this without you cussing.
No, I'm not going to. Oh, this
right,
next part?
Let's roll. SPACs. Take it away.
SPACs. So, guys, tomorrow we're going to report before. Daniel and I will be on before, just talking about, again, a little bit more about what the Fed's going to do. But again, I just wish the Fed used a little bit of common sense and just said, look, we're all seeing inflation come down in a lot of different areas, but we're not seeing it in rents and we're not seeing it in food, and we understand, right? We're all seeing the energy decline tremendously. Again, you can say strategic oil reserve or whatever, but you're seeing prices come down, which is helping consumers, even though they're more expensive than they were year over year. However, there are definitely big signs showing that your rate increases are working. And for you to say we're not seeing anything, again, to say we're seeing no signs of inflation moderating because you just saw a hot CPI number. I mean, just that's the big. It's what they're going to say afterwards. It's going to be 75 basis point hike. Maybe they go 1%. Who knows? It's all about what they're going to say afterwards. And I just think they can't say anything worse that's being priced in right now, because they can't say that they're going to tighten even more. It's going to be crazy. I mean, everything. I mean, 4% for the entire year. It's going to be over 4% short-term rates for the entire year of 2023. There's nothing the Fed didn't come out. I think it's surprise on the negative tomorrow, but yet they could surprise on the positive. And if they do, with the amount of money on the sidelines, the amount of money short, you're going to see this market absolutely surge tomorrow. And it could. I think it's a good bet. Don't go crazy. I think it's a trade, but it's a good bet because I don't think I've ever seen, I can't say ever, but man, a trade where everyone's on one side saying the Fed's not stopping, getting out of the market. I mean, we'll see. Remember, hedge funds are significantly underperforming. And if you're seeing the market go up tomorrow, they're going to jump in immediately. And that could create, a pretty big short squeeze. And let's see what happens. Anyway. segue into what Kramer was talking about this morning. And we also have, this was David Faber talking about SPACs, one of my favorite topics.
Special purpose acquisition company.
Yes. So these were very popular. I think these were very popular a while ago. And it's no secret when they were popular, it was 2005, 6, and 7. Why? Because you have more idiots with more money, right? And you have easy money policies and more people making money. You see home values go up in 5, 6, 7. People feel richer. So it's easy to sell these deals, these shitty garbage deals to the public. And when you could do that, that's why these things surged to the point where in 2020, right, we had 244 announced. 2021, 613 came to public. And then 2022, this year, it's only 76. But before this, it was pretty much less than 100. Now, when you look at statistics day, I'll set everyone up for this before I get your comments. There's still 550 in the pipeline for deals right now. And this number was over 660 because there's over 113 that were liquidated. So they come to a certain time period, they either have to pay for the extension or they remove it, they give the money back to investors. But the people who started this back and put up a few $1 million, they lose that money. The few people who started the SPACs, they lose money. That's why they want to keep pushing and pushing it. There's 164 that want to come public, meaning that they made the deals, they're just waiting to come out at $10, but maybe they're looking for different pipe deals and stuff like that. So you'll get over 700 looking to rob you to individual investors, but now the individual investors are mostly broke. So, and they got wrecked on a lot of these deals. And, Kramer was just talking about with Faber how, this is fraud, this is bullshit. But, let's start there and your thoughts on this.
I think the SPAC it was just a matter of timing, in my opinion. You had another fun story to be told during a time where you had a lot of investors ripe with money because you had stimulus, you had not layoffs in the terms of taking away, but you had the shutdown, COVID, and all that kind of stuff. I think that when I first heard about it, I assumed it was new or newer. And then, you start reading about it and you're like, oh, this is nothing new under the sun. It's just the timing of it. It is a good idea to go quickly to get public and all that. For insiders, it's great. For the individual investor, it's not so good. I'm not saying they're all bad. This is just, but I'll be the boring kind of grandpa here, Frank. A lot of these were sold as just the new world problem solver. I mean, anytime that it's just the old cliche, anytime something seems too good to be true, it probably is. And you need to look at that. Here you have, again, you can replace SPACs with crypto, tulip, .com, anything. You get very good salesmen, high-end celebrities, rich folks backing stuff. You're going to see pops. And yeah, a lot of people end up getting hurt. I know you got some great stats, some stats that you're about to share. I was blown away by. I don't care that the entity exists and the process exists to do these reverse mergers and take companies public. I don't care about that. I do have a problem with the story that's told versus the story that would be read if you do all the filings. And to your point, that's the best thing I can say, because a couple of stats you told me as to what people put up and the amount of shares they get in return. I honestly thought you were misreading it or just having fun with me. But yeah, that's pretty crazy. So I'm not against that. I'm not against the entity. I don't know if you are or if you think they shouldn't be allowed. I'm just, there has to be more transparency here, but there has to also be a huge, to your point, you want the Fed to use more common sense. Individual investors have to use some common sense as well. And just know they are only selling this because it's their book.
I always say, individual investors, you got to do your own homework and stuff like that and take responsibility. It's their money and stuff like that. There's things that they just don't know. And you can't know unless you're inside this industry. And that's why we're trying to change it. We're trying to change where Reg A offerings, unfortunately, Reg A offerings, 99% of them are going to be shit, for Reg A. The reason why you come out Reg A is because you can't do like a regular Reg D and you can't get institutions to fund it. So you want to go to all these individuals. And there's less regulation around it where, a lot of those deals, aren't going to work out, right? But the Reg A's are designed to say, okay, we want to level the playing field, but it's never level. Because you're looking at Chamath, who's canceling 2 deals, and this is why it's brought up, because the 2 deals that he's canceling that he's giving the shareholders back is one is the largest that he ever raised, which is $1.15 billion, and another one which is $460 million. And he raised that money mostly. You could say, well, is that from individual investors? No, he didn't raise that money from individual investors. He raised it from institutions. And why do institutions are giving him $1.15 billion? Because it's a guaranteed massive return, because they're getting in at 50 cents, $1, $1.50. These things come out at 10. And the only reason they come out at 10 is because that's when they go to you. They go to all the people and say, okay, how could we find enough stupid people to buy this? and buy it at a valuation where they're not going to care and they're not going to look at it. Okay, well, let's go to the general public and go out there. And then, I'll promote the hell of it and go on the New York Stock Exchange and put my thumbs up like Chamath did, across the street with Virgin, with Richard Branson saying, we're going to space. The whole world's going to space, right? Well, here's what Chamath has over you, and this is the advantage. So when you see Virgin Galactic, he has 10 million shares. 10 million shares, Daniel. How much do you think he paid for 10 million shares? Say if you're buying 10 million shares. To buy 10 million shares at $1, that's a lot of money. 10 million shares.
Yeah, I bet he got them at, I remember a few figures, but let's say he got them at 50% discount.
All right. 50% discount.
Of whatever, yeah.
Yeah, so he $16,000.
16, that's a good.
16. Do you have $15,000 to invest? Think about that, guys. Do you have $15,000 to invest right now? Some of you have, right? A lot of you have $15,000 to invest, right? If you took $15,000 of your 401k, you want to invest it. Imagine if you were able to buy 10 million shares of Virgin Galactic at 001, whatever it was. So he sold 6 million of those shares for $210 million at $34 a share. Where is Virgin Galactic now? It's $5. He's totally out of the stock. Branson sold 60 million shares. He owns like 200 million shares. And these warrants, and by the way, the great thing about SPACs is you didn't have to list like the warrant structure or anything of the pipe deals. You don't know what these people are actually getting at. And plus they have quick liquidity periods where they could sell this thing within a couple of months. Okay, opposed to what? Going into a private company, investing in a private deal, and the liquidity period before you can get out. This is why hedge funds, everybody wants liquidity. They want liquidity. When they say they want liquidity, it means we want to sell this freaking stock immediately whenever the hell we want to. That's what it means. When a hedge fund approaches you, you have a private company, they say, we need liquidity. How are we going to get liquidity? It means they want to get the hell out of your stock immediately and how to do it at the highest rate of return. That's what it means. It doesn't mean that, we want to be in your business long term. No, it doesn't mean that at all. So you guys should know that. But the liquidity part is funny because if you're going into a private company, the average liquidity period is 7 to 10 years. And the liquidity period is what? If you get bought out or if you IPO. With SPACs, the deal's already trading publicly. It's a holding company. So you don't have to go through all the red tape, all the bullshit with the regulation. And this thing comes public almost immediately. You raise the money, and then it comes out at 10 and go a lot higher based on how much they're promoting. But that's the thing. They're promoting the hell out of this. So Branson was promoting the hell out of this. He got 200 million shares. I mean, with warrants, you don't know. You don't have to disclose any of this stuff like you do in normal IPOs, S1 filings. So Branson got these 16 million shares. And if I had to guess, he probably paid like $400,000 for them. He sold just 16 million of those shares for $458 million. And he got to go to space for free. That's good. Thank you, investors, for funding that. So you look at Open Door, which is 6.3 million shares. He bought them for $15,000. Clover Health, 17 million shares. He bought them for $20,000.
Hold on. Sorry. Clover Health, how many shares?
17 million.
And how much money?
20,000.
Another good one.
SoFi, you guys know that one, right? 15 million shares at $18. So you can do the math of that. Where's SoFi is under $4. Even at $3. Even at $3. You're looking at a $45 million, right? This is at $3. If it goes to $1, it's $15 million. If it goes to $1, he made a fortune on this. $15 million on an $18,000 investment. Yet if it goes to $1, you bought it what? 10, 9, 8? You could buy it today, it goes to $1. I mean, you look at 95% decline. These guys are making money no matter what. This is why the field is not level. These are called founder shares. This is why all of Wall Street was like, holy shit, this is really working. Remember the first couple of SPACs and everybody started going in. All of Wall Street. Then you had Ackman getting in there. You had Einhorn getting in there.
Our favorite bank, Goldman, was a big player.
Everybody, yeah, because they could make an absolute fortune. But the only way this works is if you have enough idiots to buy it at 9, 10, as long as you could sell to that crowd. Because then if you're buying it, who's getting out? Who do you think is getting out? These guys that. So now you have Chamath come out and say, well, we canceled these two funds. And this is what he has the balls of saying. This is all illegal, what he did. He's brilliant. He made a lot of money for himself, but don't go out there and pretend like he wants to run for Congress now, whatever, in California. Don't pretend like, you're not bullshitting people. That's what I hate. Don't be fake. I didn't curse. Don't be fake.
Is bullshit not a curse word?
I hate fake people. That's not a curse word. No way.
That's genius.
So 2 reasons. Yeah, that's listed as non-curse words on Wall Street Unplugged. So really quick, and again, we like to keep this 30 minutes. It's going to go a little bit longer today because I'm having fun here. He said there are 2 reasons for those cancellations for the recent 2 funds, Daniel. He goes, valuation and volatility. So the valuation goes, combination of factors made it difficult to find a company at a reasonable valuation and margin of safety. Ultimately, to get a deal done would have required us stretching on price. or buying an inferior asset. Neither were those things we felt comfortable doing. What? Are you out of your mind? And then the volatility, we saw resistance from management teams who either weren't prepared for or didn't want to face the public markets in the face of the current volatility. Okay. Neither things we feel comfortable with. Okay, so Virgin Galactic that you sold at $34, that you sold this whole pipe dream that the whole world's going to space and nobody's going to space, right? Other than the guy who, Branson, and maybe like 10 other people. So right now, even now, because he went on TV, and this is like a couple months ago, he's like, look, you got to base these things on 3 years. He goes, I'm going to be seen as an enemy, but you got to base it on 3 years, Daniel. So he's like, 3 years, you'll see. I want those same people who have written me apart to write these, reports, because that's what you're going to base. First of all, you're out of the stock. You're out of the freaking stock, right? Second of all, if you're looking right now, Virgin Galactic is $5, right? And he's talking about have required a stretching on price, right? To get a deal done, it would have required us to stretch on price or basically, valuation. Neither were things we felt comfortable doing. You felt comfortable doing it with Virgin Galactic because right now at $5, it's trading at 200 times enterprise value to sales.
Ooh.
Enterprise value is just, bringing in like the cash and that's a much more pure number, 200 times. But you felt pretty comfortable coming out with it a while ago under the same conditions, right? So just don't bullshit and lie. All right, and he's going to get sued, and you know what he's going to do? He's going to take whatever. He'll get sued under the table because they're suing him right now, and he'll pay, what is he going to pay? $20 million of the $200 million plus that he generated just off of this one deal alone? I mean, when he sold his shares? So you look at Wall Street and you wonder why everybody hates Wall Street. You wonder why crypto is gathering momentum where so much of the technology is in there. Why Bitcoin was created in the first place? Because people hate this shit. Because you have people up there lying to you, absolutely lying and being fake and making a fortune off of you. And who cares if they get sued? Oh, they kick back and they know everybody they kick it back to. The top people at the SEC are all going to be working for Goldman and everybody else. That's the way it is. Just do your research. You could see that. It's not a conspiracy theory. It's just because they have the inside scoop and they make nothing from the government. And then Goldman's like, wow, this guy knows everyone within the SEC. So let's hire him and give him $5 million a year from, the 150, 125 you're making. It's the top position there. So, great. That's awesome. But just think about this, guys. This is the market. This is what you're competing against when you're buying this shit. For me, I'm trying to bring a lot of these deals to you very, very early on where you can invest. And a lot of times it is accredited investors and people get pissed. But, unfortunately, a lot of Reg A deals, and I've sifted through hundreds and hundreds of deals over the past year or two, hundreds of them, and said no to almost every single one of them. Thank God, because a lot of them are getting crushed now. But there are certain deals that are coming out that look fantastic, that could be great. But this whole SPAC market is really, it really is a joke. And for Cramer, too, Cramer's been saying it here and there, throughout the years. He represents the people. Okay, he's on TV and he knows his audience. I work for him personally. I know he cares. And now he's like, really, really ripping them. And he ripped them a few times, but he's also recommended a few of these. You need to really call these guys out over the past 2 years like we were doing. Not now when everyone's crashing. Now everyone can say, oh, these SPACs, these guys are criminals. Who cares? They made a fortune, everybody else didn't, and nothing's going to happen to them just like the credit crisis, right? So it's all, all right, you win, Daniel. It's a fucked up system. It's a fucked up system that unfortunately is at your expense, and that's really what pisses me off. It really pisses me off. It does. It pisses me off. And there's nothing you can do about it because what's going to happen at the end of the day? Nothing. Nothing's going to change. Nothing's going to change. Well, you got a couple people that are sued that made $200, $300, $400 million. They're going to get sued for what? 10, 20 million. Government makes them money. They make their money. They'll go on to whatever they do. They have 27 houses and you're broke. And they're going to continue to do that and continue to do that. And that's why you're going to see the rise of crypto, the rise of DAO, which is governance tokens when everybody could vote. It's not just bullshit board of directors making all decisions. Just with security tokens eventually. I mean, security tokens is a hot market. I hate where the current people are taking it because they're going institution to make money because they can't make money on it right now because it's a bad market. To me, the security tokens are always a way for every investor to be able to invest in really great companies during their early stages. Now it's all institution where you have to be an accredited investor to trade some of these. That's what the current companies are doing that we've dealt with, which is very, very frustrating that we used to deal with. It's like that wasn't my vision for security tokens of what they're doing right now. And I get it. You need the money. Otherwise you go broke and no one's trading security tokens. And that's how you make money off it. But still, but that's why you're seeing the rise in crypto. A lot of this bullshit, you're seeing decentralized finance with no third parties just constantly taking money out of your pocket no matter what. And you're seeing it right now,
Yeah, it's a good warning. Listen, you can't end on that note, Frank, even though I won the bet. That's fun. You call it out. You try to tell people, the individuals, and level the playing field and things. The easiest way, just look at these as either trading assets or just avoid this. There's plenty of other good core companies sectors, industries to follow, especially during times like this. But yeah, it needs to be said. I think it's great. You had a lot of great numbers there, and it is BS. It's not a level playing field. You and I can't change the rules, so you either have two decisions. You either play in the rules the way they're set up and do the right thing and build up, or you just don't play at all. And, you know, we like to fight, you especially.
It's kind of what Trump, one of the best lines I heard Trump say, and I know everyone's like cringing right now. One of the best lines I heard him say is when he was debating, I think it was Hillary Clinton, and she said something about taxing. You did this on tax. He goes, yes. He goes, yeah, I did. I made a ton of money because I knew the tax code that you created. I know all the loopholes, so I know how to change it. But he's like, if the rules are there, he's like, of course I took advantage of it. They're your rules.
Right. Your
rules suck, and I took advantage of it, he said. He actually admitted that and said, at least I know how to change that. But the rules are out there. These big guys, they know the rules. It's, if you want to play by them, and you can make money. You're probably not going to get founder shares. Even I have trouble getting founder shares. But, you could get into a lot of great deals early stage, and we do offer that through, Curzio 1. And also do Curzio Venture, although we didn't do any in the past probably 12 to 15 months at least. And I'm glad we didn't because, there's a lot of deals that I see that are just crazy dilutive. It's not that I don't want to give you more deals. I can give you everyone in the world's looking to raise money. Every company, even Microsoft and Apple raise money through the debt markets, right? Bonds. Everyone's looking to raise money, especially not just in this market, but almost all the time if you can raise money. So, it's a matter of bringing the right deals at the right time, and that's coming. And I will say this about SPACs. The companies aren't terrible companies. You could actually look and buy it. What's terrible about SPACs is the valuation they sold you on. So now you're seeing SPACs and also IPOs get murdered. But a lot of these companies are still seeing growth, except instead of buying these things at stupid, crazy, idiot valuations, now they've come down 75, 80%. And a lot of the cash they raise is still on their balance sheet. Right? Palantir is one of them, right? Daniel, you're talking about, and others. There's a lot, there's like 10 or 12 others that we'll research, and I want to get a little more research for you guys, but not too much, because we might be recommending a few. But the companies themselves, is not like you should say, okay, I'm never going to, I hate this company because it came out as a SPAC. You should always look at it at the valuation. You hate the valuation, right? So the valuations are coming in where they have a lot of cash on the balance sheets, and they still have growth. They're not growing at 40%, 50%, or even 100% some of these early stage, but they're growing faster than the market. They're trading at lower levels. They have recurring revenue. They just, there's a big difference between a company coming out at $10 and, or valuation of $300 million compared to $3 or $4 or $5 billion. And that's what you're seeing. That's why a lot of these things are getting smoked, because the valuations didn't make sense. But now they're coming down to reasonable valuations. They got good business models, decent management teams. You could actually start looking at some of these, if the Fed ever stops being an idiot and hopefully not raising rates for the next 5 years in a row. We'll see more of that tomorrow. But this is an area that we're looking at because there are some ideas that are growing faster than the market. They're now cheap, and they have very, very good business models. So
yeah, and sorry, on Palantir, they weren't a SPAC, but they were investing in a lot of SPACs, which caught my attention. And they have a lot of cash. But yeah, there are a handful of SPACs out there. Yeah, their share price has gotten absolutely hammered. However, if you just do a quick, look at FinViz or anything, just see what their cash is to total debt as a kind of a real easy sifter or, segue, or not segue, but filter to start.
Yeah, and a lot of these guys, they do have good business models still. It's just the valuation was just insane. And you could do that when the whole market's flush with cash. You're giving $11 trillion to everyone, handing that out to people, directly to people in businesses, and people just looking to invest in crazy, stupid things that they were never able to invest in. And that's where SPACs came in. So now this market is completely dead. I mean, completely dead. It's not like the SPAC market is terrible. It's just if you're going to do a SPAC, be careful, because they're coming out at 10. And remember, when you're buying at 10, there is a lot of investors that are dying to sell it to you at 10 that bought at $1. And just remember that. So at $10, it could come out at a valuation that really makes sense. Maybe they're generating money. Maybe it's coming out at 20 times forward earnings and they're growing at 40 times. They have a great business model, software, cloud, AI, whatever. That's great. But if you're generating a certain amount of money for these things, but yet you're coming out at 25 times that valuation, I mean, what do you expect when the market isn't bad? These things were crashing. Daniel, let's be fair. These things were crashing before January, right? I mean, these things were crashing like mid-2021. That's when you really saw this market actually start to collapse. Even before, like the Fed said, holy cow, we have no idea what we're doing on interest rates. It's not transitory. We got to raise like a bunch of idiots. That was before that. Just to let you know.
Well said.
Well said. Okay. Thanks, buddy. All right, Dan, thanks for joining us. You're going to join me tomorrow. It should be pretty cool.
See you tomorrow.
Yeah. So, guys, any questions, comments, frankcurzioresearch.com. Thank you so much for listening, and we'll see you tomorrow. Take care.